Borrowers are ready for a rate rise. Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of HeiseSays. Grab your stein of coffee because I want to have a look at this article from Mortgage Business. Most borrowers are ready for a rate rise according to the RBA. Now let's bring up some charts here that I want to show you everyone. Just to, remind you that people have paid ahead on their mortgages. A significant number of them have, and households have liquidity buffers. People have money stashed aside. Now, rates are going up. We're seeing it in video after video. The RBA has abandoned the 0.1% target for government bonds, and rates are slowly creeping up. The banks are preparing for costs of borrowing to increase in the next few years. Now, will this impact the housing market? There's some hoping that there'll be a correction, a 20-30% fall. Now, that will certainly be a correction if it happens, but remember, we've already gone up 20% this year. Is that the doomsayers being proven correct? It doesn't seem to be it, unless we get like a serious correction, which I'd say 50% or something insane, and we know the government will step in, throwing the future opportunities of our children and children's children out the window to ensure status quo is maintained. That precedent has been set. I would be shocked if there wasn't a government intervention that drastic, and there would be calls for it. There would be calls from all sides of the house, from all people, for drastic government intervention. That's the country and the culture that we are. Save housing at all costs. Now, will it cool housing? Will the ability for people to borrow as much be dampened, and will that cool the potential growth of housing over the next year? That's what seems to be the case, what many people are arguing, that it won't be dramatic, it'll be a cooling down. But then we also have calls for an increase in migration to Australia to above pre-COVID levels, because we need to get those numbers right back up there, guys. And then what's that going to do to housing? It's going to put more pressure and more demand on rental housing, investment housing, and houses for owner-occupiers. So let's have a look at this one here. The majority of mortgage holders are already maintaining higher loan repayments than required and won't be shaken by a climbing cash rate, according to the RBA. The Reserve Bank of Australia Assistant Governor of Economic, Lucy Ellis, appeared before the House of Representatives Standing Committee on Tax and Revenue on Monday, the 15th of November, for its ongoing inquiry into housing affordability. Reflecting on the serviceability of mortgages, the economist told the parliamentary committee that she had observed the majority of borrowers paying off more than their home loans than required by their contracts, particularly during COVID. Now people have been socking away money in offset accounts, redraw accounts during this period, and particularly where you had lockdowns, some people were not spending as much as they ordinarily would. Now, what worries me there is that the government gets a taste. Housing may be in trouble. Quick, lock down the state to lift up housing 5%. Can you see it? Property Council lobbying for housing, I'm half joking, for housing lockdowns to keep the sector going, maybe. So the Reserve Bank, she had made the comments as economists speculated a cash movement from the current historic low of 0.1 is due sooner than the RBA's previous forecast of 2024. Some have tipped an increase is on the cards as soon as November next year. The Reserve Bank itself has acknowledged that inflation has picked up faster than it expected and would eventually result in the cash rate rising in 2023. So recent surveys from the Finance Brokers Association of Australia has found 3/4 of borrowers and renters believe rising interest rates would place pressure on their financial position. Yes, it did, but what that tells me is people just suck at balancing their finances. They haven't got it sorted. That's what that's telling me. I don't think it's people about to tip over the edge. I think it's people just not having it sorted. Around 56% of the survey participants had said if rates were to increase, they would need to consider refinancing their mortgages. One important context here is that when rates do eventually rise, a lot of people will not actually need to rise their actual repayments because they're already paying more than they need to, according to their loan contracts, she told the parliamentary committee. Last week, the Reserve Bank released research around liquidity, tying a rise in household liquidity in recent decades to rocketing house prices. while aspiring buyers needed to accumulate greater levels of cash while saving for a deposit. Those who already had a mortgage have been incentivized by the threat of future shocks to make higher repayments than needed and to build up a greater cash buffer. Offset accounts were also found to be a primary driver for raised cash buffers with mortgage debt, at least since the 2010s. With the RBA noting borrowers using the product tended to have larger buffers on average and also experienced a greater rise in buffers over time. That's because putting your money in an offset account, you get a guaranteed return of what? 1.993%, depending on what interest you're paying. Whereas if you've got that cash sitting in shares, there's volatility there. If you have it sitting in cash, you get nothing. So, of course, people are going to increase those buffers. Mortgages with offset accounts currently comprise around 40% of home loans in Australia, while mortgages with redraw facilities make up around 70%. Dr. Ellis called the widespread use of offset and redraw accounts one of the most desirable features of the Australian institutional framework. Other countries do not have the widespread use of offset and redraw accounts, which are the most tax-effective form of precautionary saving ever invented, she commented. So rates are a balancing act. Dr. Ellis noted that setting the interest rate at low levels had pushed up house prices by allowing customers to service larger mortgages on the same income, but the alternatives weren't desirable from the central bank. The response I would have is that the alternative was being a higher inflationary country, much higher inflation than our peers, she reported. And that would involve difficulties attracting capital. It would involve economic instability and their swings and roundabouts. Dr. Ellis also reflected on the burden of a mortgage under different settings. If you conceptualize, you buy a home, you live in it, you pay off your mortgage. In high interest rate worlds, you end up paying more interest overall, but your income probably rose more quickly, and so those payments decline more quickly. You inflated away debt much more quickly, she said. In a low inflation world, you end up paying less interest overall, cumulatively, but the burden of that repayment doesn't inflate away quickly as when you get lower nominal income growth, she said. So let's have a look at my viewers of the channel here. I asked you in the poll, are you ready for interest rates to rise? Please share how you've prepared in the comments. Now, this poll is still open. I will link to it here so we can go through all the comments in a live episode. But I thought, just to give you an overview of the 688 people that have voted in this poll, 75% are prepared and 25% are not. Very interesting, everyone. I'm not surprised at all. I think most of the people would be prepared. So, videos to look out for, guys. I want to point you into this video here about building a housing portfolio. Check it out, the 5 easy steps that we're apparently given in this article. Let's have a look. Let me know your thoughts and opinions on that in the comments down below. Take care, guys. I'll see you next time. Bye for now.